Okay, so then we are going to look at another question called Chakula, and it's in sort of the same line with what we have seen before. So it has acquisitions in there, but also some aspects that are different. So I'm thinking this is going to be one of the last questions we do on that part. Then we look at some questions to do with risk management, and then we look at another section altogether. So it is a section A number, which means it covers not just acquisition, but a lot of other information. And the first question they're asking for here is explaining why regulatory framework related to mergers and acquisitions is necessary to protect the interest of shareholders and other stakeholders, which is a theory part to this question. And they are asking about the framework that exists for control mergers and acquisitions. So, which means that these acquisitions do not just occur without any rules. So that's what they are asking. The rules, how are they necessary to protect the interest of the shareholders and other stakeholders, which is the employees and creditors and everybody else. So we shall look at how that works. And then they will discuss two theoretical propositions as raised by last board in relation to company's capital structure. So of course we shall look at what they are proposing. But of course, capital structure is debt or equity. So most likely they are discussing whether to have more debt or more equity, or if it matters at all. So then you prepare a report for the board of LAHLA. So, and in this report, you are going to estimate the value of each of Kawa's shares if it is demerged and listed as an independent company, and then estimate the additional equity value created when combining LAHA and Kawa, percentage gain to each Dallas and Kawa's shareholder group under each payment method, as well as the impact on LAHA's capital structure under each payment method. And lastly, evaluate the financial and other factors. So when they say here financial, that's what you've been computing up. Then other factors, then you're going to look at the scenario and pick out other issues that the shareholders of LAHLA and the Kawa would consider before agreeing to the acquisition. So, and then you also talk about the impact on the capital structure under its payment method. So, now the payment methods, we haven't seen them yet, but when we read through the question, we shall see. But most likely it's going to be cash and share for share exchange. So those are the ones that normally are asked. So you need to know how to deal with both of them, because if you don't know how to deal with the share acquisition, then when it comes, you may start panicking. Yet, if you figure it out before the exam, then it's going to be something that you are not going to struggle with when you are calculating the amounts. So, having read the question, of course, there are these 10 marks, professional skills that you need to make sure that you score, like having the heading of the report, the introduction, the body, the conclusion, and the appendices. That will give you communication, appendices, analysis, and evaluation. Then some questions of what is information provided to you. And then commercial acumen normally is going to show up when you are doing some of the computations for the capital structure and other parts of the question. So now, if we go to the question, they gave us 5 exhibits. And the first one talks about the company Chakula, which is a listed company. So a large listed company, and it has 2 business sectors. So, of course, it does food production and drink supermarkets. That is the main one. And then also it has a chain of coffee shop nationwide. So now, because it does two, the board thinks that the company is undervalued and they want to focus on rapid innovation taking place in the food and drink production sector. So therefore, they want to unbundle the coffee shop. So, when a company acquires another company, that is normally through mergers or acquisitions of a different sort. But then there is what we call spinning off a company and bundling, whereby you have a company like this one, which has two main kinds of businesses, and then one of them is removed as a company. So they unbundle it and they name the company Kawa Co. And then you either demerge Kawa Co by a spin-off or you sell it. Okay. So, and then whichever you do, then you turn its full focus on the remaining business of foods and drink production. So now there are going to be two options. After you unbundle it, you demerge and you make a company called Kawa Co and you sell it. Or the one that you do is going to be a spin-off. So a spin-off, that company may still stay within your shareholding. So you still own the company, but it's operating independently of you. So initially, the shareholders of Chakula will own Kawa Co, and they be owning it on the basis of one Kawa share for every Chakula share that they have. So that is, for example, if I had 20 shares, then I also have 20 shares in the new company, Kawa Co. So there's another company here, Lala, large unlisted company. So when the company is unlisted, means that you may not get information concerning its share capital and all that, and the betas and market capitalization. It has 20 shareholders who all have a significant stake in the business. So Lala owns a number of hotels around the country and is looking to diversify to the coffee retail business. So it has approached Chakula about the possibility of purchasing Kawa Co. So, and this is that's what I told you. They are going to do it through either cash or a share for share offer. Now, if they demerge Kawa, then it will be listed on the stock exchange as an independent company. And Chakula is unsure whether to sell Kawa to Lala or to demerge it into an independent company. So this is what we are going to choose. But of course, we need some information that can help us proceed. And they have given us here some areas that we can that are for clarification. So these are two areas that they want clarification. Lala's chief executive has determined that the capital framework in the area of mergers and acquisitions is designed to protect the interests of the shareholders and other stakeholders. So this is where the first question comes from. So we are going to look at how the framework of regulations that are set up are going to affect or are going to protect the interests of the shareholders and other stakeholders. Now, what normally happens is that when a company is going to be acquired, they normally go for the big shareholders. For example, if a company has 80% owning by maybe 4 people and 20% by 5 million people. So these people might be owning one share each, for instance. So when they want to buy that company, they will normally come for the 80%. So now, of course, the shareholders that are minority may also not want to sell their shares in the company. So just give me a second. Sorry. So I was saying that they'll go for the person who owns, they'll go for this people who own 80%. So the idea is if they can get these ones, then they own the company. Because remember, ownership normally can come into control. So you control the company. Now, that is all well and good. But if they wanted to get 100%, then they will try to also get the remaining 20%. Now, the thing is, what if those people don't want to pay? So then there are now things that have been put in the regulations that can protect those shareholders. So one of the ways they can protect them is that if you pay these 80% people $5 per share, then you also have to pay these ones $5 per share. You should not discriminate based on the holdings that they have. But also those rules can also protect the person who is buying the company. Because if you acquire 80% of the company and want 100%, and these people are refusing to sell, then those regulations can also force those people to sell. Because if you are left with only 20% of the company, and you are very many people, like 5 million people, owning very small amounts of that company, there's no reason why you should hold out the company which is trying to acquire the entire company. So they will have those rules. Also, the rules will prevent management of the company that they're acquiring from stopping that acquisition. Because the shareholders, if they are okay with the acquisition, then they should be able to sell. After all, management is only serving the interests of the shareholders. And also, now when you want to buy shares in that company, you need to inform the shareholders, all of them, and give them enough time so that they can prepare to either agree or disagree to what you are providing them. So that's where those points normally come in. But of course, we shall look at how they write them when we get to the solution. Then the other thing here is that acquisition of Kawa will be a major investment for Lala, and the board has concerns about how the acquisition will be financed. So, and they have heard about these theories explaining the capital structure of the company. And they are saying these are the proposals. The company should maximize the debt financing, and that too much debt can be harmful to a company. Now, this first one here is called the Modigliani and the Mia. Okay, the one which has tax, the tax. So with tax. Now, Modigliani and Mia come from financial management, but we also looked at them here. So I don't know if you remember them, but if you don't, you can let me know. But basically, that's what we are going to explain here. Because what they said is that it does not matter. The one without tax says that it does not matter what you get, debt or equity. But the one with tax says that we can get as much debt as we can because debt is cheap. So debt is cheap. The reason why debt is cheap is because the risk of the shareholders is higher than the debt holders. Therefore, they ask you for a lower return. But also, debt is cheap because the debt, when you are paying interest, it is tax deductible. So that's why they advocate for maximizing the debt. However, the traditional view, that's another theory that we are going to discuss when we are answering this question. The traditional view for which it says that the more debt you have, the more risk you have for the shareholders. And therefore, shareholders' cost of equity will increase the more debt you have. And the weighted average cost of capital can start decreasing, but at some point, it reaches a minimum and it starts increasing again. So for them, they say that there is an optimum capital structure, the optimum level of gearing that we can have. So that is the point. So these are the two that we are going to discuss. What we have said here is sufficient for you to get the marks. All that I'm going to show you is just how it is written down so that you are able to copy the way the structure is, and then you'll be able to also make something like that. But don't write a lot like they are writing in the solution, because we said they write a lot because they are trying to make you use this for learning purposes. So now, what is the structure as it exists here? This is from Chakula. So it has assets and minus current liabilities. Then it has now the part of the liabilities, the long-term and equity. So we have share capital, we have reserves, then we do have two loans. There's a loan note A and loan note B. So we shall see how to deal with those loans. The shares are trading at 2.5 each, 2.45 each, and the equity value of Kawa is 1.2 billion. So now the loan notes A have a market value of 2.1 billion, and loan notes B have a market value of 400 million. But after unbundling, the loan notes B will be serviced by Kawa, and loan notes A will remain with Chakula. So they are going to split those loans. Some of them will go to Kawa, the others will go to Chakula. And the post-tax cost of debt for loan notes B is going to be 3.52. So this is something that they have given us. Then Kawa will maintain its capital structure after the unbundling. So we shall see what is going to happen, because we have been given the debt, so we are going to get the equity, get its capital structure. The debt to equity ratio of Lara is 40/60, and it's in market value terms, and we have 1,200 million shares in each, or 1.2 billion shares. Then cost of equity for Kawa is 13.5%, and they pay tax at 20% per year in the same year as the profits. That's also important. So that is the structure. So then, of course, if the company is demerged, this is what is going to be the information. So the sales revenue is 4.5 billion, of which 20% is for Kawa. So after Kawa is demerged, the annual sales revenue growth rate will be 6%. So after Kawa is demerged, the annual sales revenue growth will be 6%. The profit margin before interest and tax will be 21% of the sales revenue for each of the next 4 years. Then the current tax allowable depreciation will remain equivalent to the amount of investment. This is a very important statement, and I'm going to explain it to you. I think I've talked about it before, but you see, when we are calculating normally for NPV, we add back the tax depreciation because it's not a cash flow. But they have told us that the current tax allowable depreciation will remain equivalent to the amount of investment needed to maintain the current level of operations, which means that the depreciation that we're supposed to add back is equal to how much more we are going to have to invest for the keeping the level of the assets at that level, which means that those two cancel out, and therefore we don't have to add back depreciation. But we shall require an additional investment of 0.25 for every dollar increase in sales revenue. So that is some investment in assets. Then after the initial 4 years, the growth rate of the cash flows is going to be 2.5% for the foreseeable future. That's the demerged company. And then we have the acquisition part. So I realize that the information is a lot as you read it. So I make sure that you have some kind of workflow of how to utilize it. So make sure I read through it very fast. And then when you start now doing the question, you also pick information that is essential. So it's all about knowing what information should I pick for what calculation. So now for the acquisition, that's what's going to happen if Lala acquires Kawa. So the price earnings ratio for the hostel industry is 15.6. However, Lala's P ratios is 10% lower than this. So it means that this is the one that is average, but the one for Lala is 10% lower. So we shall need to get the one for Lala. This is the P&L for Lala and Kawa. So so you have profits before interest and tax, then you have interest, then tax, then profit after tax. Now, they're saying that after acquisition, the PE ratio of the combined company will be the midpoint between the two individual companies' PE ratios. So the average. Annual after-tax profit will increase by 26%, and by 62 million because of combining the two companies. So Lala has proposed to pay for acquiring Kawa either through cash offer of $0.66 for the share of Kawa, or 1 Lala Co share for every 3 Kawa shares. And it will have to borrow the money that it needs for the acquisition. So that is how we are. So we realize that we have used the approximately 30 minutes to read the question, or 20 minutes, 25 there. But it's because I was explaining to you as I read. So you have to read a little bit faster. And as you read, you should be capturing information. So as usual, I go to the calculation. Then when we go to the solution, we shall see how this answer that. So what we are going to first determine is if it is demerged and listed in as an independent company. That's what we are going to look at first. So you can say if demerged. So now, of course, you have known where that information is, because they told us here there is here Kawa as a demerged company. That's what we are going to go. Now, having gone there, you realize that we have been given revenue of Chakula is 4.5, but 20% is Kawa. So we have been given interest. The growth rate will be 6% and profit margin will be 21%. The current tax depreciation is equivalent. So now we need to know information about Kawa, because remember what we want is to look at the question. We are looking at the value of the Kawa share if it is demerged. So to know that, we need to know the value of each share. So now we know information about its revenue. Okay, so the revenue is 20% of this 4.5 billion. So Kawa revenue, 20% of 4.5 billion. So we have been given this in millions, so we can just work in that. So at all figures in millions of dollars, that we don't have to keep on repeating it. So this is the revenue that Kawa has, and they have told us
Hello.
Yes.
I beg your pardon, on the Kawa revenue, you said it's 40%.
20%. You see, they're saying that Chakula's revenue is 4.5 million, but 20% is attributable to Kawa. So that's why we did 20% of the 4.5 million. Okay?
Yes.
Yeah. Then we have the sales growth. The sales growth, they said, is going to be 6%. And then they told us that the profit before interest and tax, PBIT growth, going to be 21%. Not PBI as a percentage, okay, of revenue, 21%. Then, of course, now we can now set up our cash flows. So remember, this is going to be for 4 years. So we can put our years here. So normally we start with year 0, but it depends on if you have information concerning year 0, because Kawa, when we demerge it, we are just going to determine so the cash flows. So we are going to, of course, start with our revenue. So let's start with the out. So now revenue, this is the current revenue, and it's going to grow by 6%. So we are going to start with this revenue. So we grow it by 6%. Now we are going to multiply, we are going to power this to power 1 so that we have the formula can be extended. So notice that I'm fixing out the first revenue and also the growth of sales revenue, so that when I drag the formula, it brings me the other figures. So that is my revenue. Then they told us that PBIT, so they gave us that PBIT is going to be 21%. We can now multiply by PBIT, by the revenue to get the PBIT. That is our profit before interest and tax. And then now do tax. Tax they pay, I think they pay 20%. Yeah, 20%. So it's the same year. So having done the tax, so normal idea here, you say add depreciation, but they've told us that the depreciation, the same amount of depreciation is normally invested to keep the assets at the current level. So we don't have to add anything. Not yet. There is something that I remember they said also. They said an additional investment in assets of 0.25 for every dollar increase in revenue. So we can put additional investment. Now they said 0.25 for every dollar increase in revenue, which means that what we are going to do, we are going to start with, of course, 0.25 multiplied by the revenue of 25954 minus 900. That gives you 13.5. It's a cash outflow. And if you are working in, you can choose to work in whole numbers. So I'm going to work in whole numbers. Then you can now drag the formula. But remember, now you're supposed to get 1011 minus 954. You can drag the formula like that. That's the additional investment. And since we said let's work in whole numbers, you can round that one off. So then you can now get our total cash flows. Okay, so you get our total cash flows. These are total cash flows. Now from here, we need discount factor, but at what cost of capital? Because when Kawa Co is demerged, what's going to be its cost of capital? We know cost of equity is 13.5. So we need the working appendix. You can have here another working Kawa Co cost of capital. Now, for cost of capital, normally I use the weighted average cost of capital. So if we are to just bring out the formula sheet. So if we are to use the weighted average cost of capital, this is what we need to have. It have KE, have KD, have VE, it have VD. Need to know tax. Those are the things we need to know. The cost of equity, KE, is 13.51. Now KD. Okay. So we need to know if they gave us KD, so we can look and see. I remember seeing it. So let me just, yeah. You see loan notes B. Remember what they told us that loan notes A and B. Then after the unbundling, loan notes B will be serviced by Kawa. So that's 3.52%. And they said that these are post-tax cost of debt, which means that this is KD 1 minus T. And therefore, I don't have to have T here anymore. Because now this is already a post-tax. So then what I need is value of equity and value of debt.
Hello.
Yes.
I'd like to ask, what does unbundling mean?
Yeah, what I was saying, that if you have a company, and now like this company which deals with the two different business areas, so unbundling means splitting one part of that business area and making a company of its own. So now, like, these people have been dealing in foods and drinks, but also the other part of, I think, coffee. So they decided to break off the part of coffee to make a company called Kawa Co. That's unbundling.
Okay.
Yeah. So we need to know what's the value of equity and value of debt. So we need to see how the split is going to be. The split is 40-60. And what we need to know is whether they are going to split it like that. So let's see. 40-60. But we have 1,200 shares. Let's see. So we have the equity value of Kawa Co, 1.2 billion. So we're working in millions, so we don't have to worry about that. We already said overs are millions. So what about the value of debt? So the value of debt, remember that the market value of debt itself is 400, because we are looking at loan notes B, 400 million. That's the one that is going to go to Kawa Co, loan note B. So we have everything, so we can get the work. So which is going to be value of equity divided by KE plus value of debt multiplied by KD1 minus T divided by value of equity plus value of debt, which gives us 11%. So 11%, of course, if you check 11.013, but we can just take it 11%. Now we can now come here and say at 11%. In fact, now that we know it's 11%, we can just say present value. Okay, we don't have to because the cash flows are in sequence. We don't have to maybe bring in the idea of, we can just say present value at 11%. Or we can actually just say present value of the free cash flows, because this is what they normally call them, cash flows at 11%. And we don't have to now do the present value individually. You can just say is equal to NPV, and you give it the rate, which is 11%, give it cash flows from year one, like that. And you have yourself your present value. So it is 494.
Hello.
Yes.
I'd like to ask, where did you get the 400 from? Because I didn't see it in the question.
The 400 is here. The loan notes B have the total market value of 400 million.
Okay.
Okay. So after having the present value, the free cash flow, so we have to year 4. So now we need to determine, we need to first of all see whether, because this company did not say it's going to stop at year 4. So let's see what they told us anything to do with what expects the free cash flows. So after the initial 4 years, okay, they are saying here that the initial 4 years, the annual growth rate of the company's free cash flow is going to be 2.5% for the foreseeable future. Which means, so this is present value of cash flows from year 1 to 4. So this is from year 1 to 4. So then then present value of free cash flows. So let's just year 5 onwards. Year 5 onwards. Now this one utilizes this formula here, the growth model. Okay, this formula here, the growth model, is what we normally use for that kind of thing. So they told us it's going to grow by how much? By 2.5%. So it means that you start with the one that was in year 4. Also, I need to, okay, then I need to have put something here. So let me not summarize it like this because we need the one for year 4. And so let's get here the discount factor, 7%. So 1 plus 11% power minus n. Then now we can get the present value. Present value as the product of these two. Then now we can now have the present value. So if you now add these ones, you get the same answer. It's just that now I wanted to have, so it's still 494. But now from year 5 onwards, you get the one of year 4, the cash flow of year 4. Okay, so which is the 175. Then you multiply it by 1 plus the growth, and the growth is 2.5%. Then you divide it by the 11% minus 2.5%. So that gives you 2105. Okay, but now we have to discount it. We have to discount it. So we normally discount it at the same discount rate as the year 4. So we can just multiply by 0.658. That gives you 1386. So now we can get the value of Kawa Co as the sum of these two figures. Now 188. So after getting that, this is the total value. So this is the total value. You can say total value. Then if I want to get now the equity value, Kawa, now I need to determine how much is the split for equity and debt. So now let's see what they said about that breakdown. Cost of equity is 13.5. We can actually just look at it at this point. You see, so where we put here equity and debt. So if I want to know the value of equity, if I divide it by equity and debt, I get 75%. So Kawa is 75% equity, 25% debt. So which means that I can come here and now multiply this. But so that let me not just leave it as a 75%. I'm going to just say equity divided by equity plus debt, just to get the proportion. So now what I get here is 1412. Remember, these are millions. So this is the equity value. What about the equity value per share of Kawa? Because this is the total equity value. What about per share? So how many shares does Kawa have? they told us that Kawa has do you remember seeing them? Mr. Chakula has these shares. So the whole company for the shares. So these are for LAR. Oh, we have information here of share. No, this is profit. Let me see where that is.
Hello.
Yep.
I've seen a 0 point.
Yeah, this is for Chakula.
I've seen a 0.25 down.
Yeah, seen the 0.5 down.
It's like I've seen
0.25.
a 0.25.
No, this is the share. This is because you
Here.
see here.
Oh,
You
sorry.
see,
It's okay.
yeah, because you see here, the company itself has 1 million 0.5 shares, right? So,
Yes.
so we can get the shares of Chakula. Okay. So, because if you get 1 million divided by 0.5, you get 2 million. So those are the shares of Chakula. But they are saying that Kawa will maintain its capital structure after unbundling. So it means that the shareholder, and also they say that after unbundling, what will happen is that the existing shareholders of Chakula will own Kawa 1 share per each, which means that Chakula will have 2 million shares, but also Kawa will have 2 million shares. So which means that the equity value you're going to get 1,000 divided by 0.5. That gives you 2 million shares. But now we want to know the value per share, which means that we are going to do this one, and then you divide it by the shares that you have. Okay, which gives you $0.71 per share. I don't know if you have understood what we've done here. Have you understood that part?
I've understood, but okay, I haven't yet. I'm trying to understand why we are taking Chakula's
Chakula's shares.
share. Yes.
Yes. Okay, let me take you to that part. When they do merge, I remember seeing it somewhere. Okay, first find it. Yeah, okay, it's here. You see, they're saying Chakula will then either demerge through a spin-off or they sell, right? Then they're saying that Chakula's shareholders will own Kawa on the basis of owning 1 Kawa share for every Chakula share owned by them. So what it means there is that since the shareholders of Chakula have 2 million shares, they will also own Kawa 2 million shares. So that's what the statement means, which means that the shares of Chakula will be also the same number as the shares of Kawa. Because you think of it this way, the company was just born out of their own company. So for convenience, it is still their company, just that they have put it aside as a separate company. So if you have 2,000 shares or 2 million shares in Chakula, you also have 2 million shares in Kawa. So that's why we are using the shares of Chakula. Is that clear?
Yes.
Yeah. Okay. So having got the equity value per share of the Kawa shares, then we can now look at whether, because the question asked us, because it's going to answer the question as they asked you to determine the value of Kawa. Okay, we have got that. So that's appendix 1. Now, then the additional equity value combined when combining Lara and Kawa, then the gain of Lara's and Kawa's shareholders under each payment method and the impact. So what maybe you can realize this case is that what they told us that Kawa had a value of how much in terms of equity. Told us it was it. We are looking for the market value of Kawa. The one that was given, not the one we calculated. So Chakula has 2.1, the loan notes. Okay. Lala's debt equity ratio, cost of equity. Okay. Remember seeing the figure 1.2 million. Uh, just locate it if you can see it.
Um,
Or is it the one we already put it somewhere here? I was just trying to look for it. I don't seem to find it, but we already have it here. So let's just put the figure here, 1.2 million. So what was the original value per share? So now we know that it was 1.2 million, and the shares we just found out that they are 2,000 or 2 million. So the original value was 0.6. Means that there's been a gain of 0.7 minus 0.6 divided by 0.6. It's been a gain of 18%. Okay, so there's been a gain of 18% if they demerge. So this is the gain if demerged. Remember, when we are going to start explaining now, you're going to say which option should they take. So we have done if it's demerged. Now, the other part they're asking us is what if this part here, what if we sell the company to Lala? So that means that we are going to combine Lala and Kawa. So we are going to look at appendix 2, sale of Kawa to Lala. So when we sell, what we need to determine here for the combined company, how it works, you get the value of Kawa alone, the value of Lala alone, then the combined value, then you see the synergies. And we know the value of Kawa is 1.2 million, 1.2 billion. Now we need to determine the value of Lala. So for Lala, they told us that it has a PE ratio. This is the one of the combined company, but there is a PE ratio they gave us for 15.6 is the average, but Lala is 10% lower, which means that the Lala PE ratio is 10%, which means 90%, 10% lower, 90% of 15.61, which becomes 14.05. So now when you know the PE ratio and you know the earnings per share, let's see if we have the earnings per share. We have the total earnings anyway, not per share, but total earnings, 171. So we can get Lala's equity value. So we are going to have the earnings of 171. We are still working in millions, multiplied by 14.05. So maybe because it's another appendix, we should put it back here again, or figures in millions. So that gives us the value of 2.4 million, the value of Lala. Then we know Kawa, the value is 1.2. So having known the value of Kawa and the value of Lala, so we know that the PE ratio of the combined company, they told us, is going to be the midpoint of the individual company's PE ratios. So we need to know the PE ratio of Kawa. So how do you get the PE ratio of Kawa? The PE ratio is price per earning. So we need the earnings, we know them, 117, and the price is the valuation of 1.2 billion. So we are going to get 1.2 billion divided by 117.1. So that's the PE ratio of Kawa. Therefore, the PE ratio of the combined company, remember they say that it's the midpoint between the two individual companies' PE ratio. So we get 14.05 plus 10.25 divided by 2. So you get 12.15. That's the PE ratio of the combined company. Then we can get now the equity value, the combined company. So remember, we got the equity value by multiplying the PE ratio by the earnings after tax. So 12.15 multiplied by the after tax earnings. Now, the after tax,
Hello?
yes.
Could you go back to the PE ratio of the combined company?
Yeah.
Yes.
Yeah. It's the midpoint of the one of Lala and the one of Kawa. So you add them, then you divide by 2.
Okay.
Yeah. So now to get the equity value of the combined company, we need the PE ratio, but we also need the earnings. Okay. So the earnings or the profit after tax of the combined company. We need those ones. So let's see if they have told us what will happen. Because these are the profits before tax. So basically, you are going to add those two. Then we are going to look for whether there is some synergies. And they're saying that they'll increase by 62 million. Therefore, the profit after tax will be 171.0 plus 117.1 plus 62 gives us 350.1. So we can now multiply the PE by these earnings and we get 4253. So now maybe I can summarize it here for you to know what's happening. So we have Laha equity value, $2,402, then Kawa equity value 1,200. Together, when you add them, they give you 3,602. But the combined company equity value, we got 4253. So which means that there is some, yeah.
How did you get the 4253?
No, that one you just get the PE of the combined company, then multiply it by the after tax profits or the earnings. It's profit after tax. So you just multiply 12.15 times 350. So which means that there is some synergy of 651. That's the additional equity. So this is not the synergy benefits. 651 million. Okay? Yeah.
Hello?
Yeah?
Here, on the equity value of the combined company, you multiplied it times 1,000.
You multiply 12.15 times 350.
Oh, okay. It's okay.
Okay. So now this is the synergy benefit. Now, they told us to calculate for under each payment method. So additional value, that part is calculated. That is the part here of 651 million. Now they want us to look at the percentage gain to each of the shares of Lala and Kawa shareholders under each payment method. So there are two methods. We have a cash payment method. So for cash payment method, they said that when they pay cash, they pay $0.66 for the Kawa shares, which means that the cash paid is going to be 0.66 multiplied by 2,000 shares. We're working in millions, so that is, there are 2 million shares, but we are working in millions. So we are still, that is 1.32 million. Okay. So that's how much money will be paid. But the original, so the Kawa original value we got, was it 1,200? I think that was 1,200 for equity value. This one here. Remember, we wrote it somewhere. Yeah, 0.6 which is the 1,200 per share. So it's okay. Then now we can look at the gain. Now the gain is going to be 1,320 minus 1,200 divided by the 1,200. So the gain is 10%. And this is also gain per share. So under cash acquisition scheme, this is the gain for Kawa. Okay, so Kawa shareholders will gain 10%. Then we need to know what about the Lala's shareholders. So now for Lala, what we are going to do is to, of course, determine the combined equity value. Then we are going to subtract the cash that they are going to pay so that we can see how much value they are going to get. So Lala's shareholder value is going to be the combined equity value minus the cash that they are paying. So that is 2933. So, and how many shares do they have? They said has 1.2 billion shares. So therefore, the shareholders, okay, Lala's shares 1,200. Therefore, Lala's,
Ella,
yeah,
how did you get the 2933? The shareholders value?
now this is the company's combined value, 4253. But to get it, we had to pay some cash of 1.32 billion. So you subtract those two, that's the value that the Lala's shareholders are now worth. You understand that part?
Yes.
Yeah. Now, this is the value. So per share, they are at about 2.44. So what was their original value? Original value for Lala was Lala. They told us that it has 40/60 in terms of equity debt ratio, and the cost of equity is 13.5. I need to see whether they mentioned what was the value. So we can look at their financials, see if we have information. But did we get the value of Lada when we computed? Just first see.
Yes.
Yeah, 2402. Okay, this is the equity value that Lada had. So, value 2402. Then I'm just going to determine by the shares. So I'm going to divide right away. So let me just say original value per share. So they were about $2. Now they are 2.44. So there's a gain for Lala of 2.44 minus 2 divided by 2. So Lala shareholders have gained 22% per share. So you realize that they have benefited better than the Kawa shareholders. For them, they have got 22%. So that is the cash offer. Then we have the share for share offer. Now, a share for share offer, they said they are giving you 1 share of Lala for every 3 shares that Kawa has. So what are the additional shares issued? So remember that Kawa had 1,200 shares. So for every 3, they issue 1. Means that they are issuing about 400 shares. Okay? 400 shares. But now these were not 1,200, they are 2 million shares for Kawa. So there are 2,000 shares, 2 million shares. So that is 667 million shares. And we know, so now how many total shares we have? So they had 1,200. Now they have issued another 667. So they have 1,867 shares. So now equity value per share. Remember, the combined company has equity value of 4253. Now it's going to be divided over 1,867,000 shares. So the value is about 2.28 per share. So now let's see the gain. Kawa shareholders. So the Kawa shareholders, of course, for them, they have given away 3 shares. So 3 shares, and each of their shares was worth 0.6.
Hello.
Yes.
How did you get the 2.28?
So you understand the 1,867?
Yes.
So the 1,867 now are the total shares that they have. So to get the equity value per share, you get the equity value of the combined company and you divide it by 1,867. So that is the value per share.
Okay.
Yeah. So now the Kawa shareholders, before, remember, their share was at 0.6. Where we did this value here for the value of Kawa shareholders per share 0.6. So 0.6 times 3 shares, that gives you 1.8. But now the share now is at 2.28. So when you subtract those two, the gain is 0.48. Okay. Now 0.48, that's the gain that they have made. So which you can determine in terms of percentage. Oh, let me actually show this in steps. Shares of weighted share value weighted is 0.6 times 3 because they are giving out free shares. So the gain is 2.28 minus 1.8. So the gain percentage is going to be 0.48 divided by 1.8. So the percentage is about 27%. So you realize that when they are doing share for share, they get better what? Return. Because Kawa before got 10%, now it has 27% gain. Yeah.
How did you get? Wait, is that 1,800? Because I thought you said 0.6.
Yeah, it's 1.8. I left some zeros there, but it's 1.8. It's 0.6 times 3. because their share was 0.6, and they have to give out 3 of them so that they can get 1 for Lahal. So that's how you do the math. So 1.8 is what they are giving up, and they are getting 2.28. So they are gaining 0.48, which is 27%. Then for Lahal,
Wait, how did you get the 0.8?
the 0.8 or the 1.8? 0.48?
The 0.48.
It's the 2.28 minus 1.8. Because the 2.28 is now how much the shares are. And the shares that they have given away were worth 1.8. So the difference is the gain. Yeah. Then for the Laha, remember their shares were $2, and now they are now 2.28. So it's going to be $2.28 minus $2, which gives them a gain of 0.28. So if you can put in percentage terms, 0.28 divided by 2. So for them, they get a percentage change of 14%. Okay, so now that answers that part of the percentage gain. Now we are left with the last computation of the impact on the capital structure under each payment method. So we can make that one. Remember, what we have chosen to do is, yeah.
I'd like to ask, how did you get the 14%?
The 14%, because the gain is 0.28, so divide by the original value of 2. That's how you get the 14%.
Okay.
So now the structure. So under each payment, we are going to look at, remember they say that when we pay cash, so what saying is that we have chosen to put appendix 3 for all this, since the questions without in the notes, I mean in the text itself. But now that we are already here, let's just get the capital structure. Under the cash offer. So under the cash offer, we are only looking at Lara's capital structure. So capital structure for Lara was, before the acquisition, was 40/60. Okay, so the structure before 40/60. So if we're going to borrow, we are going to get more debt. Remember that the marketing value, yeah,
Sorry to take you back.
yeah,
Under the part that says share for share,
yes,
we computed and got an equity value per share of 2.28.
yes,
Is it?
yeah.
So the additional shares that we're getting, are they both for Lala and Kawa? Because I noticed that to get the gain for Lala under the share for sure, you got the 2.8 minus the
Two.
original value per share
Yeah.
of
So,
Lala.
so you see now what happens when you merge a company with the share for share acquisition. So the shareholders of Kawa will be given new shares of Lala. So now the shares that they all have will be the ones that are for 2.28. So that's why we are using 2.28 to compare. So for Kawa, we compare the 2.28 to this 1.8 being the 0.6 times 3 shares that they are taking away. Then for Lala, we compare 2.28 to the 2 that it had before. So we are using the same 2.28 because the company now has merged and now the shares are the same now. You get?
Okay.
Yeah. Okay. So the capital structure. So the company, if we look at the value that we had, because we already did some of this work already, we know that the shareholder value is 2933, which is the market value of equity. Now, market value of debt, because now we are going to now use cash, right? So when you are using cash, so we need to determine how much are we paying. Where's the cash payment? We are paying 1.32. So we are going to have that 1.32. And remember that market value of debt is going to be, remember they say that here it's right now 40/60, right? So which means, and this is debt to equity, which means that for debt it's going to be 40%. So if equity is 2933, then debt, so before merger, so that we can use these figures for after the merger. Before the merger, market value of equity is that, and market value of debt is basically supposed to be 40. So it means that we are going to get 40, we get 1955. And first of all, the market value of equity is a combined company. Before we bring that figures there, it's actually the value of Lala, equity value of Lala. So this is what we have, the merger. So after the merger, what's the market value of equity now? Now remember that we know that after when we do the acquisition, the market value of equity is going to be,
Hello.
yeah.
How did you get the market value of debt?
Oh, now they say that it's 40/60 debt to equity. So it means that if this is equity 2402, then to get debt multiplied by 40/60 times this 2402. That's how you get the market value of debt. Then, so after the merger, the equity is now 2933. And now market value of debt is going to be, first of all, it will be this 1602 that it had before. Then you add the money that you're going to need to pay, which is 1320. That is cash that you have to pay. And also the debt of loan notes B, 400 million, will be now serviced. It will be part of the Kawa. So that gives you 3322. Okay, so now, because before it was 40/60, now what is this percentage? So this divided by the sum, that is so now it is 53/47. Okay, so it is 53/47.
Hello?
Yeah.
How did you get the 3322? Okay, how did you get the market value of debt?
You get the one that was there before the merger. Then they told us that when we use cash, we shall have to borrow the cash. So the 1320 is also borrowed. And then also the 400 for loan notes B, which are serviced by Kawa. So that's going to be the debt of the combined company. Remember the 400?
Yes.
Yeah. So that's how we get the market value of debt for the combined company now after the merger. So this becomes 53/47. I wanted to just only show, okay. Let me just put 53/47. So you realize that now the debt has increased when we use cash offer. Now let's look at share for share. So now we are going to have again market value of equity, market value of debt. Now, if we do share for share exchange, market value of equity, we have it. This is the 4253 combined value. And then market value of debt. Now, when we use share for share, that means we are not going to borrow money. So it's just going to be this 1602 plus 400. We shall not borrow any money. So if you now get the proportions of this, that is 30/68. So now we have all the calculations that we needed. Okay, so we need to now go and start discussing. Before we go there, is the calculation okay now? I know some of these things you have to go back and look at them again because, I mean, you see these numbers are similar to what we've done before, but there's always going to be something new.
Yes.
Yeah. So let's go now to the solution so that we see how they are laying out. So we are looking at our so the first question was asking us about the regulatory framework and whether and how it helps. So the reason that it exists, as we said, it is to ensure that the interests of the stakeholders are protected and where natural market forces may not be sufficient on their own to ensure that this happens. So now, This is what they are looking at. The major shareholder. So if you look at the shareholders and you start with that, because they are the major stakeholders, it establishes that shareholders of the target company are not affected negatively by ensuring that the minority shareholders' rights are protected. Like I was explaining, the people who have 20% should be paid the same as the other people who have 80%. The target company's management cannot block M&A where it is in the commercial and economic benefits of the shareholders, and that time is given sufficient for the proposal to be properly scrutinized. So you don't want people to come and say, buying the company, then they say, deal is expiring tomorrow evening. That is not how that should work. Also, it ensures that enough information has been provided that people can be able to identify the proposal and analyze it very well. Then the other stakeholders, so here we ensure that there is not a substantial lessening of competition after merger and acquisition. Now, imagine we wake up and MTN and Airtel merge together to form another company, and now there's only MTN or there's only Airtel. So competition will reduce completely, and you would have now monopoly. MTN will have to charge whatever prices they want because they know you don't have options. So that's something that they don't want. So therefore, sometimes a company may try to acquire another company and the rules refuse. They say no, you shouldn't. So they will protect choice of consumers, suppliers, and employees, determining where they want to be trading. So that is what that comes to. Now, so now these things that I discussed, Migrini and Mida, okay, I'm going to leave you to go to this section and basically look at how they are drafting that statement. But remember, we said that without tax or with tax, so the one that is, if there's tax, that's the one that we are going to look at, and that's the one which says that you should have as much debt as you can, because debt is cheaper and also interest is dividend. I mean, interest is tax deductible. So the so-called tax shield. Then the other one talks about whether the tax shield doesn't have problems. So here is where I talk about if the shareholders see that the cost of debt is giving them risk, therefore they increase the cost of capital, and there is a trade-off where the cost of capital is at the minimum. So you don't have to write big paragraphs like these ones. You can basically write a couple of sentences, like 3 sentences here, 3 sentences here, as long as you capture the gist of the information that has been that you want to display. So now when it comes to the report, they actually start by, remember, the heading, then the introduction. Report discusses the financial and other factors to consider prior to agreeing the acquisition, and they are summarizing it here. Okay, when there's a demerger, the shareholders of Kawa gain 18.3%. Then when there's a cash acquisition, the Kawa shareholders gain 10%, and the ones of Laha gain 20%. Then when there is share for share exchange, the Kawa gets 26.7 and the Lala gets 14. So these are the things we have calculated up. So they have just summarized them in this table. And now you can now start explaining. So now when you look at it, it means it looks like the demerger is better for Kawa. So the demerger is the better option for Kawa compared to an acquisition, if the acquisition is cash, okay, because they get 18% instead of 10%. However, if they are doing share for share exchange, then the return is higher compared to the demerger, and therefore, on purely financial terms, remember they told us to talk about financial and other factors to consider. So on purely financial terms, then the option is 2, do acquisition, share for share exchange. Although some value is lost by the Lala's shareholders when they do share for share exchange, they would probably still be earning because the company value increase and so the value of the shareholders. But now they have to, yeah.
Hello? I'd like to ask,
Mm,
okay, as you have said, like we shouldn't write so much detail.
yeah.
Like I believe that those key points that you would probably want your student to write in the exam that you know that would earn them marks. So I was wondering, as opposed to us going through maybe the okay
The
this part
solution.
of the kit,
Mm,
may is there a way maybe you could take us through, like, okay, how can I say it, like the key points you would write if you were doing the exam set. As we're reading, we can look, as we're reading and also practicing, we
mm,
can maybe benchmark and also maybe know which key points to write to write down. Because when, okay, yes, the kids usually have too much detail, but
mm.
sometimes it may be a little, okay, you'd reach a point and ask yourself, like, what key points do I need to write down that I know would help me earn marks?
Yeah. So now for that one, the advice is you answer based on the question. Like you see how here they have told us to evaluate financial and other factors. So you are supposed to to come to a conclusion. So the first thing that you see, which has been done, and it has been done well, is to summarize what you have got as your solution, right? Now,
Mm,
the part that comes here is basically trying to to explain what you put here. So, what you could say, you can say that for if you look at just the merger is better than acquisition by cash for Kawa. However, the acquisition for share exchange is better than the demerger because it gives a higher additional value to the Kawa shareholders. You see that I've summarized these things in like one paragraph. Then you
mm,
can come to the next one and say, although Lara's shareholders benefit more if it was a cash payment, they probably would still benefit from the share acquisition because it adds value to the company as a whole. So that answer that you have given is evaluating on the financial only. So then
mm.
if you want to put a small subheading, non-financial factors or other factors to consider. Okay, so one of the factors considered is going to be the gearing, the capital structure. Because remember, from what we have seen, when we do a cash acquisition, we increase the gearing, and when we do share for share, we reduce the gearing. So you say that although maybe a share for share acquisition would be better for us, if you believe that there is a capital structure which gives you the least cost of capital, and maybe it is this one, then you do choose maybe to instead borrow so that you can increase your gearing because of the fact that the tax shield and the debt is cheaper. But you realize I cannot tell you which key points to put because you always find those points depending on the question and what the scenario is given. The key points
Oh,
that you should always put is you should always answer the question. Like, for example, make sure that when you are answering, you don't miss, if they're asking for assumptions, at least have like a short heading, put assumptions, and don't have to explain them so much. If they ask you to conclude on what method to choose, you make sure that at least maybe in your conclusion you say, based on the financial and non-financial factors, maybe we should do a share for share acquisition. Make sure that that comes out. So if you don't say it, even if it's very obvious, you won't get the mark for it. Get the idea?
Oh, yes.
Hmm.
So you're saying that literally after you doing the calculation and you evaluate your answers,
Hmm.
you respond to the question basing on your results. Is
Yes.
it
Yes. You
okay?
respond to the questions that are given based on your results.
Okay.
And try to be summarized because you already have the results already shown in the appendices. So you just say the cost of capital, if it was about cost of capital, you say the cost of capital is 14%, as shown in Appendix 1. Then if there's something to talk about it there, you talk about it, depending on whether they asked you to discuss cost of capital. The reason I take you to the solution is, of course, they are going to make those points and I will highlight them, but you would have more things to learn. Now, like here, this thing, we summarize it in 2 sentences. Okay. Although they wrote them very big, but we have summarized them into short sentences. And now here they are going to the other factors to consider, which you can also make it as a summarized as a subheading, and then you are going to make some of these points, but without having to beat so much detail. So I'm going to show you, for example, uh, first of all, we are using estimates. Okay, so that means you can say the figures that we are using are estimates, and therefore we may need to do sensitivity analysis so that we are able to get different scenarios done. You don't have to continue with it. Okay, so you see, I'm saying predictions are here, sensitivity analysis. That's the point that we always find in most of the questions, because whenever you look at cash forecasts, you need to discuss that they are estimates. Now, yeah. Another thing, so would be, so now here they're talking about Kawa's shareholders, but you can look at them generally. But first of all, the shareholders of Kawa are going to become part of a large company. Okay, so they need to consider whether that's going to suit their needs. So sometimes people want to have control of a company, and if they lose it, then they are not going to be able to influence anything that happens in that company. So if that's not what they want, then they would rather get cash and then just go. Again, I'm summarizing it so that you understand what may be important for you to write. Okay. Now, yeah. Also, they may now think of, so now like this one is the therefore. So it means this is basically building from the first one. So you don't have to write 2 points that seem to build from each other. So you can skip that. Okay, but yeah. So for learning purposes, you read it so that everything you read is going to help you somehow to build muscle for what to write. So it's okay to read it for learning purposes. But if you are doing the paper, you wouldn't now need to write that. Okay. Now, then they also need to look at the value that of 26.7 for the share for share, whether it is realistic or not. So remember, the company is not listed, so the valuations may not be accurate. So that's where you also may stop. Because it's very rare for you to find a company which is very undervalued that when you buy it, you can increase your value by 26%. Otherwise, if that's the case, then why are people not buying that company before you even find it? Okay, so yeah. Then the other thing is that because this company is not listed, so it may not be liquid, like in terms of selling the shares. So if they want to exit the company, how are they going to sell the shares? Which is also something they should consider. And therefore, on that ground, they may maybe prefer to be given cash up front. And finally, it's going to be the gearing, okay, which we did last of when the share capital changes. So you see here now they bring the table of the capital structures, how they change. So it was 60-40, Now, when you use cash, 49.53, 46.53, and then when you use shares, 6.32. So we got these ones here, and you just have to mention that it's going to have an effect on their gearing. And they are talking about many things here, but we know what is important, right? What is important is that the gearing structure may change the cost of capital, and so therefore they have to choose which one is optimal. So you don't have to write all of this. This is just, if you read through, you're going to see that they are explaining what I've just mentioned. Okay, but summarizing it, yeah. And then now here, these things are also where they have them, so you may skip them, and now they conclude. Okay, the conclusion normally is based on financial, because you can't conclude on non-financial since they are subjective. So because the share for share arrangement is the one which gives them the highest return, therefore that's what they should accept. And they'll get a higher equity, and therefore they can be able to get more debt if they need. Then you discuss the fact that there is also other factors. So you summarize those other factors there also. Don't have to summarize them detailed like that. You may just say, however, the ladders compound, we also need to consider some of the factors that have been highlighted above. Then you don't stop, you don't bring them back here. So, unfortunately, this is going to be something that you do per question in terms of how to determine what content to write. Calculations guide you, and the requirements, what is required of you. Those are the two things that guide you.
Okay.
Yeah. So what you do to get for me, I'm not opposed to you doing a question and sharing with me so that I can see what you've done. Although I have not yet been able to receive some questions from people. So what if you find a question and you want to know if you have written enough content on it? Okay, you share with me what you've written, and I tell you.
Okay.
Mm. Okay, so do you have any more questions for me, or shall we close the session?
No, I don't have questions.
Okay. All right, so have a good night. See you tomorrow.
Really, thank you.
Bye.